Hey everybody, welcome to the show. This is a recorded conference call, an investor's conference call for investing the right way. Again, I need everybody to go ahead and mute your phones, mute your computers, because I'm hearing echoes and stuff in the background. So if you're not muted, go ahead and mute that for me real quick, please. That's much better. All right, so in this particular episode or investors conference call, we got a slew of things that we're going to discuss. We're going to break it into sections. It will actually be a learning experience. We're not just going to discuss the market and what we think is going on or anything. We're actually hopefully going to teach you a few things. We're going to record this video and release it as a podcast, but if you are watching this as a podcast and you get to those particular things that you want to turn around and listen to later, we're going to record separate classes for those particular things that we're going to discuss. So that way you don't have to listen to all this fluff. In order to show you the things that we're going to need to show you, what I'm going to need you to do is log into your tracking software. If you use TC2000, you log into your TC2000, get that pulled up. You're also going to need to log into your option trading platform of choice. For most of it, that's eOption. So log into your eOption account. So again, TC2000 or whatever tracking software you're using, and your option trading account. Some of you may be like on TD Ameritrade and you're using it all built into one. Whatever you're using, I need you to log into those and be prepared for that. While you're logging into those, I will go ahead and give you an update on the last trade that we just got into. Got into a trade on TLT. Tango Lima Tango on Thursday. Bought a contract for 26 cents or $26. I felt that it was at the bottom of its trade range. It turned around and immediately moved against me and went to 4 cents or $4. At that point in time, I figured, okay, now it's really on the bottom. So I bought 4 more contracts to kind of offset my losses, hoping that it would gain. This particular stock, it's not actually a stock, it's an ETF fund. It tends to gap up when it gaps up, so I was hoping that it would gap up in the morning. The idea was that if it did gap up, I would immediately gain a profit, and I'd just go ahead and cash out. I wouldn't wait for the rest of the day. The stock also has a habit of lingering, so it will move into a position and stay there for hours on end before it actually goes through its trade range, sometimes. And since this was going to be on Friday, overnight to Friday, I didn't want time value to turn around and erode all my profits. So I just settled in my mind that I was going to take a profit if it did gap up. That's exactly what happened. It opened up at 18 cents. So I bought the 4 for 4 cents and went to 18 cents or $4 to $18. That was a 400% return on that investment, which turned around and wiped out any losses that I had on the one for 26. In fact, I gained most of that back. If I'd have been just a little bit more patient, and allowed it to go through its cycle, it did trade on up to, I could have sold it at one point for 36 cents. That's an 800% return on investment. But we never, ever kick ourselves over taking a win because we definitely took a win and needed that. All right, so by now, all of you guys should have up your TC2000 and your trading platform of choice, whatever that is. And the first thing that I want to talk about is I want to give you something for free. So some of you guys are subscribed to the Instant Alert programs where you pay a subscription fee currently, as I'm recording this, of $50 a month. We have honest, I swear to God, plans to drop that as we go forward. But for anybody that is currently subscribed and for any new subscribers, we're going to give you my online backup program. Another number of you guys have followed me over from the photography side. You know I have a small company called Jimmy Drive. It is an online backup company that is a competitor to Carbonite, LiveDrive, Backblaze, those guys, where we have unlimited backup for your computer. Well, I'm going to give you a free account. It will back up everything on your computer, irregardless of the hard drive size, and it will back up as many portable hard drives that you have plugged into it as you can plug into it. If you have 25 terabyte portable hard drives plugged in, it'll back them all up totally 100% for free, included with the subscription to Instant Alerts. So if you guys are on Instant Alerts, I will need you to reach out to me directly via phone call at the number advertised at the website, and we'll set you up manually. If, by chance, you're already a member of the Jimmy Drive program, we will cancel your actual subscription fee to that, whatever rate that you're paying, and say that and still keep you in that program. You won't have to do anything different. Your program will continue with Jimmy Drive. You just won't pay anything more for it if you're a member of the Instant Alerts. But again, I will need you to actually pick up the phone and call me so we can make those arrangements. So my gift to you, saying thank you for helping me pay the bills for right now. So the next thing I want to go into is an update on the market, and here's where Mr. Tanner can come in. Tanner, why don't you jump in, and I'm going to go ahead and bring up the S&P 500 on my chart here as soon as I find it. And I want to get Tanner's thoughts on what the market is doing and where we're at and where he thinks we're headed.
Well, we have been in a time of consolidation. If you notice, the old trend, it hadn't even come close to the old trend lines from a couple of months ago. It showed all kinds of weakness. However, it shows all kinds of strength at the support line. If you see your support line is a 50-day exponential moving average. And so it's got all kinds of support. However, it's showing indecision, which is why implied volatility has been decreased quite a bit. Right now, we've been seeing lower than normal volume, especially on an up move to an all-time high as far as closing. So we're really looking for it to break through that resistance line
at the top.
That Jimmy drew and put out on Facebook and on the website. If it breaks through that on higher than normal volume, then we will go up into the old trade range. If it doesn't, then we expect it to continue to stay in this channel and move up and down 2 or 3 days at a time. It's going to either break really hard up or it's going to break really hard down. Because after a time of consolidation like this, ever since March, early March, after a time like this, you're going to end up seeing the stock market break one way or the other really, really, really hard. And so getting into long-term type of plays, I would not recommend, which is why the double day play is such a great tool to use.
So, the double day plays become our trade of choice. Because you're in it for such a short amount of time, you don't have to let it hold for 3 or 4 days. You can usually get in and get out the very same day. In fact, that's the overall strategy. Sometimes we do hold overnight, but not past a Friday.
Right.
Now, for those of you guys that have not drawn trend lines, I'd like for you to draw some trend lines on the S&P 500 on your daily chart. We put this out on the Facebook page and on the front page of the website, but if you have not done so, I'm going to give you the numbers that I'm using so that you can kind of gauge what we're looking at. You can draw your own trend lines, of course, if you want to, but this is what we're doing. If you go to calendar date 5/7/14, and I'm drawing a trend line off the bottom of that wick to the next calendar date of 5/16/14, a trend line between both of those wicks. I then created a parallel line, drug that parallel line up to the top, and you have to forgive me for just a second because I just got a text message from Brett. He's saying there's a lot of echo when Tanner's talking. All right, I have dropped the volume on my speakers on my end, so hopefully, Brett, that'll take care of that. If it doesn't, please let me know. All right, so that's our trend lines, and that's the first time, Tanner, that we've been able to really draw trend lines in 2 months.
Yeah, exactly.
I I think this is the best opportunity that the S&P 500 has had to actually break up and head to that, magical Nirvana 2000 area on the S&P. What do you think?
Yes, absolutely. And the reason why I agree with you, Jimmy, is because the amount of support on the bottom. It tested the 50-day 1, 2, 3, 4, 5 times in a very short period of time since April 28th, and it just keeps bouncing up off of it. So.
All right. So, do you want to add anything about the market? Where do you think we're going from here? Your gut instinct says we're going to where?
I know where the big boys want to take it. They want to take it up, because that's how they make the most money, and that's how they keep the public involved. So that is my gut. Is they're going to try. They're going to try to break through this line and break up into the previous trading channel. And Tuesday will be a good day. It'll be the day that we get that. They have the entire weekend to talk about the fact that the S&P 500 closed at an all-time high.
Yeah.
Day weekend. So they're going to be pushing that. Now, here's where you have to be really careful as a trader, because on Tuesday, if they gap it up to open the S&P, and they've marketed the entire weekend that it's at an all-time high, they may use that as an opportunity to sell into the gap. In other words, the big boys will sell to the public and then drive it down. Now, we've seen that happen a couple of times. If you take a look back on, let's see here, what date? It's 4/24, April 24th. You see how they gapped it up after that down day? They gapped it up quite a bit, and they gapped it up to the resistance line there, and then they sold it off, and then they bought it back.
I'm looking for that date myself. You said April the 24th?
That's correct.
That would be this day. Okay.
See how it moved down the day before?
Right.
It moved down and closed at
1875, roughly.
Yeah, and then they gapped it up the next day.
To 1878.
And then it moved up to the resistance line that we've got drawn.
I'm sorry, they gapped it up to 1881. They gapped it.
Okay. Yep, 1881.97.
Yeah, that's a big gap. And it traded up.
It traded
hit our
up
resistance
initially.
line.
That's right. And then it traded down, and they sold their positions. Okay? The big boys did. They sold it to the public in the excitement of the gap. Because sometimes a gap is a wonderful thing. In other words, it's gapping because of really, really, really good news, and it's got all kinds of support on the gap. But sometimes the big boys, they will gap it so that they can get the public to be excited about buying them. And they're selling their position. The big boys are selling their position to the public who's excited about buying. And so if you take a look at what happened over the next 2 days, it sold off all the way down to the 50.
Right. Yep.
So on Tuesday, we need to see how it opens. If it gaps up to open, then we need to set. Of course, Tuesday's not the greatest day to do a double day play because the cost of the options are a whole lot more than what they would be on Thursday or Friday. So but if they gap it up on Tuesday, I would be very interested to see what happens. And this is one of those times when I'm going to sit and wait for amateur hour to finish so that I can see what the big boys are actually going to do with it.
Now, we keep mentioning Tuesday, and I have to let the people know who may be watching this recorded podcast a year from now. Monday is a 3-day weekend. It's going to be closed. The markets will be closed. So our Monday is actually going to be Tuesday. That's why Tanner keeps referencing Tuesday.
Yeah. So we'll watch what happens. the best thing is it's going to happen on Tuesday, which means we'll probably be standing on the sidelines watching it, and then as the week plays out, that's when we'll determine what kind of position we'll get into later on in the week.
Okay. Now, the next thing I want to go into, and this ties in directly to the Doubleday play, if those of you have watched those particular episodes, I'm not through recording them. There's at least one more final episode to that Doubleday series that I'm recording, but we're still honing out some of these things. We're tweaking it behind the scenes, and I want to hang off on that last recording until I do. But if you've watched the 4 that are in existence now, one of the things that we said that was crucially important is you need to know what the average daily movement is of a particular stock before you get into it. If it only has 20 cents worth of movement, irregardless of how it, visually appears on your screen, that's not a play you want to get into. You need something that moves across strike prices. And the only way to determine that is to see what the average daily movement of the particular stock is. Now, in that video, we gave you some math that is associated to the implied volatility listed in the chart when you go to look for an option to buy. If you look over to the implied volatility column, you'll be able to take that number, do some math to determine what the average daily range of the movement of that stock is. Well, we have a new tool for you. I'm going to show it to you here in TC2000, a Worden product. It's not something that is proprietary to Worden. So if you're using some other trading platform, you'll have to look for it there. It may require a phone call. What it's called on Worden is average true range. And I actually place that at the bottom of my chart over my volume indicator. So what I'm going to do is I'm actually going to get rid of it and add it back so that I can add it with you guys. Actually, I can just add it straight in. Up at the very top left-hand corner of the chart, you'll have a green plus sign. Click that. That'll pull up a window, and you want to type in, just type in true range, and it should pull it up really quick. Average true range. Click that. That's going to open it up at the very, very bottom of the screen. And its indicator says average true range 14 by default. You want to click that. You want to edit it. You want to change it to 30. You also want to change the color of your plot to whatever color you want, green, blue, whatever helps you visually see it. I'm going to leave it alone for now. Say OK. And now I want to move that and overlay it on top of my volume. Well, right next to where it says average true range, if you look left to that, it said there's a move indicator. When you click that, simply click on overlay over the volume portion, and it will show up there. Now I'm going to go ahead and delete mine. But now you'll have 3 columns. So if you're following the same layout that we've showed you on the tutorials at the website, you will have your volume, the average volume over 90 days. There'll be a line for that. And then you'll have a stochastics overlaying as well. And now you get average true range. So the current column that I have says 55.4.1 thousand. That's our average volume, or that volume for yesterday if you're on a daily chart. The next column will be our stochastics indicator. I'm looking at the S&P 500. It's showing me 79.89. It's in almost overbought territory, not quite. Making a gap scenario like Tanner told you about for Tuesday, very likely. And then the final column says 15.35, and that is the average daily movement of this particular stock. We're on the S&P 500. Let's jump over to Netflix, NFLX, so you can get a better indicator, NFLX. And now my average true range indicator shows me that over the last 30 days, the average movement of this particular stock is $15.49, $15.50. That's how much it moves. And this is a great tool because let's go ahead and pull up your option chains. I'm on Netflix right now, and pull up what am I on, a put or a call? Let's see, I am currently on... I'm on calls and puts. Throw in a put. Doesn't matter. When you throw in a put and you look, what you'll find is a strike price for this particular stock currently as it sits is $2.50 intervals. Every $2.50 is a strike price. Well, if the average true range or average daily movement says that it's 1550, do the math, that's 6 strike prices worth of movement in a day that this will do. You got to get the option that you're looking for to cross strike prices. The more strike prices it crosses, the greater likelihood that you're going to get double, triples, 1,000% return, 6,000% return. The largest return that I've actually paper traded. Unfortunately, I haven't been in that trade yet, but the largest one I paper traded as we were preparing this was 6,700% return on an investment in a day. It went from, I think it was Goldman Sachs, and it went from 2 cents or $2 to like $3 and change. I don't remember exactly what it was, but it calculated out to 6,700%. Tanner did one on the day that we actually the day before we actually physically started applying money to this. Tanner traded one for Priceline, brother, and help me if I'm wrong. It went from like 30 cents to $13.
Yes. That's
And
correct.
that's a 6,000% return on investment. And that was a day. That was in a day. So we really like this play. We really like this play. Do I have any questions over the average true range? If so, please unmute your mic and speak up. Going in 3, 2, 1. All right. Tanner, do you have anything to add about that particular thing, the average true range, and maybe why it's important or whatever?
Well, if you're buying an out of the money option that's going to expire later on today, it has to move in your favor. Period. and if the chart is saying that the stock is going to move in a particular direction, and you get into it, for example, like Jimmy was saying, if you're getting into a play that only has an average true range of, well, let's say it has a true range of $1, but you're $2.50 away from the next strike price, you're going to want to skip it. You just don't even want to play it. And so it is one of the tools. It's one of the last tools. Once I find a stock that I want to play that's in some sort of predictable, repeatable, reliable pattern, and is moving in a particular direction, it's one of the last things that I check to determine whether I'm going to do the play or not. So you just need to have an idea about what its average movement is, and we'll get into even looking at half of it here in a few minutes. But the amount, the total, the tool is a fabulous tool. Otherwise, you would have to do a whole lot of work, and you can do a whole lot of work if you want to, but you can measure between each day's close and the next day's close, including the wicks for the next day, and you can come up with it on your own. But if you're using TC2000 or software that has something that's comparable to average true range, that has the average true range, you can do that, and it'll help determine whether the play you're getting into has the likelihood of success or not. So, fabulous tool.
All right. That leads me into our next topic, and it has to do with Gamma. And so we'll use the last trade that we got into, TLT. So if you guys will pull up your option chains for TLT, and we're going to look at puts. We're just going to look at puts. TLT on a put, and we're going to look at the closest expiration date, which is 6 days away, be this coming Friday. And scroll down to where you see the separation between out of the money and in the money, and just sit right there, and we're going to talk. Now, I kind of blew it up big on my screen, so hopefully people can see it on the recording. I'm not that blind that I needed to do that to read it. I just wanted people to see it on the recording. So we're going to talk about Gamma. So the Gamma column, let me scroll up and show you, is this second to last column, if you're an E option, that's your gamma. Now, if you think back to the tutorial on the Doubleday play, we referred to gamma like the accelerator in a car. The closer that you get to that separation line between out of the money and in the money, the closer you get to it, the more the foot down goes down on the accelerator, the faster it begins to accelerate in volume. Once you cross out of the money to in the money, it begins to let up off the accelerator, and it's slowing down as you go deeper into the money. And so the great thing about the Doubleday play is you're getting something just out of the money and you're moving towards to being in the money. You don't, and we're going to show that to you right now, you don't necessarily have to cross into the money to get the most amount of profit potential. Okay, so one of the things we said is you cross into the money, you gain intrinsic value, but that doesn't always necessarily help you. The most important thing in all of this, is gamma, that accelerator, and we're going to give you an example of that for TLT right now on this particular stock. So where TLT expiration date is on Friday. Obviously, these prices are going to change as we lose time value. They're actually going to become cheaper, but you'll still get an example even though we're so far out. And so what we're doing is you could look at the gamma column and you could do some math to go from, let's look at the strike price of, say, $110. The gamma on that is 0.083. We'll call it 8. The next gamma jump at the very next strike price, which is only 50 cents away, is 11, and then 13, and then 16 as you go down the gamma column. Well, you realize that those are about 3 apart, 2 or 3 apart, depending on where you are on the column, and they look the same. They're not actually the same. And so you can visually see the difference, though, if you just look at the bid price. Just look at the bid price column. So here's the bid price column for that $110 strike price, and it's 2 cents. Well, the very next strike price down is only 3 cents. That's only a 1 cent increase in value for moving to the next strike price. The next strike price after that is 5 cents, $111. And here's where you begin to look at your target. So if I bounce over and look at TLT on my tracking software, TC2000, my average daily range says 0.96 or 96 cents. We'll call it $1 to keep our math simple. So I get $1 worth of movement. I have 50-cent strike price intervals. So I'm going to move 2 strike prices in a day on average. Okay, it could move more, could move less, but that's the average. So I'm looking for that 2 strike price interval. Where am I going to get the most bang for my buck? Well, at $111, you can see I go from 5 cents on the bid to 10 cents on the bid to 20 cents on the bid. That becomes my target range. If I look at because I'm going to move across 2 strike prices, so 111 to 111.50 to 112, that's my range right there. If I move up and get closer and try to say, well, I want to get it so it falls in the money, though, Jimmy. I want to get it so it gets that intrinsic value. Well, look at the one for 112. You go from 20 cents to 39 cents, not quite a double, and then you go from 39 cents to 66 cents. That's nowhere near a double. You get your most bang for your buck actually at the 111 strike price. 111 to 150 is a double. 111.50 to 112 is another double again. That is, help me with my math, but that is a 400% return on investment if we crossed across those strike prices. Tanner, did I explain that right before I open it up to questions about that?
Yes, that's correct. So
Okay.
That's your sweet spot.
It's my sweet spot. So the point and lesson of this is it doesn't necessarily have to cross into the money to get the most profit out of our option choice. We're looking for the sweet spot, and that sweet spot could be out of the money the entire range, or it could be partly out of the money and then into the money. It could be entirely in the money. That won't always happen. That will never happen. But you'll never find one where it's totally in the money where you get the most bang for your buck. But it doesn't have to actually cross into the money for you to get your most swing. The simple way to do it, though, and this is actually tied to gamma, is just look at your bid price and find out where you're getting the most amount of increase. So TLT, here we are 6 days away. These are Friday's numbers. okay? And you can see on TLT, we can actually get doubles out of this thing. We can do a double day play on this stock, even so far out. One of the reasons why I like TLT. Now let's look at one more example, okay, and we'll open it up for discussion, and that is SPY. So let's pull up SPY. Let me scroll up and see where I'm at here. Give me just a second. We're looking at SPY, puts only, same expiration date, 6 days out. SPY, puts only, 6 days out. Now, we're too far out to get a double, but let's go down and find that separation point. Again, for you guys that have not played SPY, you'll see several different versions. You'll see SPY, which is the normal contract, which is what we'll be purchasing. You'll see SPY J, which is a jumbo. That's not a contract of 100. That's a contract for 1,000. And then you'll see SPY 7, which is a broken contract of 10 options only. So the one we're looking at and paying attention to is the one that says SPY. And oh, by the way, these big numbers right here is the amount of people that have purchased it and are open interest. And you can see that's where all the open interest and volume is coming from, is on the regular SPY. Very few people are actually buying the jumbos and the broken contracts. But let's look. Let's see. If I'm going to actually start trying to get the most amount of swing, if I go to the strike price of 189, its bid is 41 cents. To the next strike price, 50 cents away of 189.50, that's 53 cents. That's 17 cents or 18? 17, I think. That's 17-cent increase. 53 cents to 70 cents is 18 cents. That's 18. And then this next 70 cents to the next one in the money would be 91, be 21 cents. And after that, it begins to drop. That's my sweet spot in there. So if I go back to find out what the average true range or average daily movement on SPY, I can see it's $1.58. They're in 3 or 50 cent strike price intervals. That's 3 strike prices. That's my sweet spot. So 53, the 189.50 is my target window. That's the one I want to buy if I was buying a put. 53 cents to 70 cents to end the money at 91 cents. This example, the sweet spot actually does fall in the money. So now I'm going to open it up to questions. Well, first of all, Tanner, do you have any feedback on what I just said? Was I clear as mud on that?
You did a good job. The thing about SPY is it's early in the week, and it would be something that we would look at further into the week.
Yeah, we're not getting a double now, but on a Thursday or Friday, the first one out of the money is probably going to be worth 30 cents versus the 70 cents it's worth right now, and you would get doubles.
Yep. And so, I mean, this is part of determining whether you do the play early in the week or not. Because like you saw with TLT, even though we were 6 days out or 7 days out or 6 days out from expiration from the screenshots, you can still play it as a double day play early in the week just because of how it's priced. So, very good.
Somebody on the text message on the screen says, are we supposed to be able to see your screen? And there's conversation saying that they can't see it. Okay, you should start being able to see the screen now. Oh, my apologies. You know what? Maybe I won't record this and leave it. Because I didn't start sharing my screen until just now. Hopefully you guys had your own stuff up on the screen or able to follow along, and I gave you just enough information. I apologize for not noticing that early. Now you should probably even be able to see, I don't know, could you guys see the camera prior to all this?
Yeah, we could see you the whole time.
Okay. I
just thought maybe because you were recording it that we couldn't see your screen. I would have said something.
Well, I did record the screen, so it's going to be recording my screen and I had all that information up. So I'll go ahead and do that. So I apologize to you guys listening live. Holy cow, that's embarrassing. So go ahead and does anybody have any questions about finding the sweet spot and how gamma is more important than actual intrinsic value when it comes to determining which option you get into and how that relates ideally to average true range or the average movement of the stock? Everybody totally 100% got that. There's no questions or any concerns about what we just said. Going in 3, 2, 1. Okay. That's great. That means we've been doing such a fantastic job of teaching, Tanner, that, we should be getting paid for this. All right. So the next one that I have on my agenda is something called a strangle and a straddle. Okay. So Tanner, what is a strangle and a straddle? What's the difference between the two?
Straddle is literally buying the same strike price, both a call and a put. And the only time you would do that is if the price of the stock is exactly at a strike price.
And we're going to give a great example of that in a minute.
Yes, and you're as long as your average true range is enough to move in one direction, hard enough, or in two directions, you could actually make money on both sides, the call and the put, as long as you sold them separately. But you usually would make enough on one side of the movement, on the call or the put, to not only cover the cost of buying the other side, but to make a profit. Now, a strangle, you would buy a strangle, which is buy two different strike prices. One strike price would be for the put, and one strike price would be for the call. And you would use a strangle if the stock's price is very close to being in between. I'm talking about 50% away from the call strike price and 50% away from the put strike price. So
let me recap that.
Yeah.
So both a strangle and a straddle is buying a position that is a call and a put on the same stock at the same time. The only difference between a straddle and a strangle is a straddle has the same strike price and a strangle has two separate strike prices. Correct?
That's correct.
Okay. Now, there's a caveat to this. We're going to show you the best way to use a straddle and a strangle using the Doubleday play. We're going to show you a great example of that in just a second. But I want to tell you that in order to do a straddle or a strangle, if you look through your e-option trading account or whatever platform that you're using, you're going to find straddle and strangle, and it's a one-click purchase, meaning I buy them both at the exact same time. I buy the put and the call at the exact same time. There's just one catch to that. In order to be able to purchase that, you need level 3 option trading privileges. Most of the people on this call only have level 2. Okay, so that brings up the next question. Well, is there a way around that? Yes, there is. I'm going to show you that. And second of all, how can I get level 3 trading? Well, how you get level 3 trading is different for each trading platform. We're using e-option. I would suggest that you call e-option or whatever platform that you're using and ask them directly, because you'll hear different things depending on who answers the phone. But one of the main things for e-option, which most of you guys are using, is you need a trading account valued of at least $2,000. Okay, well, if you don't have $2,000 in your account, you can't get level 3. Just work on it. Now, is there a way around it? Yes. The difference is you're going to have to manually do it. You're going to have to manually buy the call option and then bounce over once you've tendered that transaction and manually buy the put option a few minutes later. okay, which means it's really difficult then to maximize your return, but you can get that done really quick, probably within 60 seconds, so there's not too much delay. You can still manually do it. You just can't have the system buy them for you both at the same time, okay? So let's look at a perfect scenario of when you would want to apply a straddle or a strangle in the double day play scenario. So I want you guys to pull up Netflix, all right? And if you're using eOption, I want you to pull up Netflix on calls and puts. Pull them up under calls and puts on your drop down. Instead of saying just calls or puts, say both. And we'll go with, again, the closest expiration date, which is Friday, that's 6 days away. And I want you to scroll down until you find the separation. You'll have, if you're in eOption, your screen will look like this. Remember, gray rows are in the money and white rows are out of the money. And what you're looking at is on one side of the page you have calls, and on the other side of the page you have puts, and in that middle column you have the actual strike price. Well, if you knew that the stock was going to open up at a strike price, that would and there was enough average daily movement in the option or in the stock to wipe out the differences of the other one, you would be in a great position to play that. Okay? Netflix is in a really great position if the market were about to open. Because if I look at the last price, let me scroll up. The last price says 402.35. Well, these strike prices are in $2.50 intervals. So if I scroll back down, I look and I've got one at 402.50, really close to the 402.35. Okay, less 15 cents away, 20 cents away. I'm horrible at math. It's only 20 cents away. This, if the stock's about to open at that strike price, and we're going to be very close to opening up at the money. That means it's either going to go up or down, and the average daily movement of this stock is $15.50. That means it's going to move across, on average, 6 strike prices. That's going to more than wipe out the losses on the other side. You can do this as a straddle, which means you can have 2 different strike prices, or you can do it as a straddle with the same strike price, or a strangle with 2 different strike prices. Okay? In this particular scenario, you would want the same exact strike price or a straddle. Where did I get this wrong, Tanner?
Notice how the bid and the ask are almost identical.
Yes. Now, the bid and ask here is $6.70 roughly on the bid, and we are 6 days away. As we get closer with experience, that's going to be about 60 cents. So you're looking at a total investment of the call and the put of $1.20. If that's outside your budget, then obviously don't play it. If the stock is Facebook and it only moves $1.50 and they're 50-cent intervals, you probably don't want to play it. But on something like an Amazon, a Google, a Netflix that has, $15 worth of movement in it a day and a $2.50 strike price, absolutely. So you'll have to do a little bit of watching. Don't just say, oh, look, that stock's going to open at a strike price. I'll straddle or strangle it. No, you got to do all the rest of your homework too. Tanner?
And the thing is Facebook, it may actually be at a later date in a good position to play this. Because right now you're looking at a total cost to get into a straddle on Netflix of $14.40 if you're just using your ask price, or you're using your ask price. But with the movement, you could turn around and sell one. Let's say that it was making a doji, but it was still going to move the same distance trade range during a day. If it moved up, what would you do? You would sell one side of it. You'd sell your call side, right? and then you would continue to hold the put side and let it go ahead and play itself down, and then you would sell your put side later. So you have the potential of making money on both sides. However, if it moves really hard in one direction and only one direction, one side will become worthless, but you will more than make enough money to cover the cost for the whole play. So,
And actually, on Friday, Netflix was in that scenario. So if you guys will jump over to your TC2000 and pull up your Netflix on the daily chart, you will see that on Friday, when the stock opened, we were right there at the top of its trade range. In fact, the previous day, Thursday, gave us a doji. So you're like, it's probably going to turn down, but you don't really know for sure. Well, if you look at futures, and futures says it's going to open where it closed, and that's where it closed, and it's going to open at 391.38. We're going to pretend here for a minute that's not near a strike price, but let's say it was going to open up at 390. You looked at futures, and you can see it was going to open up at 390. I know your next question, how can I see futures? I'll get to that. Well, $390 is a strike price. If it was going to open at 390, 390.01, 390.20, that's right at the money. That would have been a great opportunity because you're saying, well, it should turn down based, I think it's at the top of its trade range. It's outside of its Bollinger Band. It should turn down. It gave me a doji yesterday indicating a probable direction change, but I don't really know for sure. However, the average daily movement is $15.50. That's 6 strike prices worth of movement. I'll just go ahead and straddle or strangle that puppy, and we'll see what it does. And you manually buy a call, and you manually buy a put for $390 on the strike price, and you spend 60 to 70 cents. I've seen it go to 80. We'll go high end. We'll say it was 80 cents a piece. Well, that's $160 or $1.60, right? $160 for both the call and the put, purchased separately, but as close together as quickly as you possibly can, right as the stock market opened, not waiting to get past amateur hour, capturing it as close to that $390 value as you could, and then waited to see what it did. And what did it do? On this particular day, it moved $10 roughly up. So you would have lost money on the put, but you would have made enough money on the top side, the $10 worth of movement that it did move up on. It didn't move the full $15. It moved 10, and hey, you would have made, plenty. You probably, I'm going to guess that was probably a 400% return on investment after the loss of the put on the other side. Does that make sense? Tanner, did I get that right?
yep, that's correct. And what I want to do is use the same example. It opened at 391.64, which is almost in the middle between two strike prices.
That would have been a strangle situation.
That would have been a strangle situation. It's a little bit too much, or not too much. To be in the middle, it would have had to open at 391.25. But you could have still played a strangle on that with the most risk coming on the call side, I believe. Yes. Most risk would have come on the call side of it. So if it would have fallen from there, you would have had to fall in more to break even. But still, the scenario is, its average movement would have covered the cost of playing both sides.
And in fact, even though it didn't move the full $15.50, which is the average movement, it still moved enough that you would have made probably a 400% return on your investment, accounting that's including the losses off the opposite side, the put.
That's exactly right.
You couldn't have done this with IBM. You couldn't have done that with Facebook. You couldn't have done that with you could have done it with Priceline. But though, in order to get in a straddle or strangle that doubles the investment amount, and some of you guys are not in a position to do that, but some of you are. And so we wanted to show you that and how that ties into the double day play. So any questions on that, because otherwise we're almost done. So any questions on this specific thing, the straddle or strangle? Going, gone. All right. Now I want any questions, comments, concerns about anything, whether or not we've talked about it on this particular show. We go through this every time. They just will not ask questions.
Hey, I got something for you.
Okay, Greg.
The VXX and TLT, is there any like correlation between the stock market? Like if the stock market goes up, they'll go down.
Yes and no. Okay, so let's cover TLT first before we cover VIX. I'll cover TLT. I'll let Tanner talk about VIX. Okay, so TLT is, I told you it was an ETF, so it's not an actual stock like a company like Ford or something like that. It's an ETF, and it's actually tied directly to the 20-year Treasury. Well, here's how that works. If the 20-year Treasury, if the interest rate on the return goes up, TLT is going to move down in value. If the interest rate goes down on the return, so it's yielding a lower profit return, then TLT will move up. It moves the opposite direction of the interest rate on the 20-year Treasury. Well, now you have to ask yourself, what affects the yield on the 20-year Treasury? Well, if everybody and their brother is buying the Treasury, the interest rate drops. They actually drop the interest rate because they don't need to give you a premium interest rate with a high yield of return. Why? Because it's in demand. Everybody wants it. But if nobody's buying it, well, they raise the interest rate in order to entice people in. Okay, well, if that's how that works, how does that tie to the actual stock market, our economy, and the economy in the world? Remember, Americans aren't the only one buying a 20-year Treasury bond. It's open to the entire world. So you can have people in China, people in Europe, all over Asia, Russia even. Russians are buying these things. So people in England. So that's tied to their economy. So if our stock market is moving down in value, that means there's less money to be made in equities, the stocks. So more people are gravitating towards treasuries. And if more people are gravitating towards treasuries, the interest rate goes down, which means TLT goes up. But it's tied to the global world economy. And that's why you don't see a direct, dollar for dollar, penny for penny movement on the stock market. If you did, it would look just like the S&P does, only in reverse. And it doesn't, because it's tied to the world economy. Do you understand that, Greg?
Yeah, yep.
Is there any questions about TLT at all before I turn Tanner loose on the VIX? Going once? All right. VXX. Tanner, take it away.
VXX is a volatility index, and its big brother is VIX, Victor IX. Can you tell I wasn't part of the military. So, but VXX has been around for quite a while, and if you take a look at its history, it's done almost nothing except for go down over time. However, it started in the when they first started it was at like 8,000 per share, and volume was really low. But as the stock market has increased, volatility has decreased. Is what normally happens. So VIX is tied to volatility. And you notice how the stock market has pretty much been going sideways for the last few months, or last couple of months especially. Well, because it's been going sideways, VXX, has been going down in value. Whenever you take a look at what SPY is doing, or what the S&P 500 is doing, every time that it goes down for a correction, you will see VIX the volatility index, you'll see it go up in value. So it's kind of a reverse. They're not tied together exactly. In other words, it's not a bear ETF or something like that that's tied to the S&P 500, because the S&P 500 can go down and VIX will not go up.
It'll just barely move or just sit there stagnant.
That's exactly right. But if the S&P 500 drops drastically in a very volatile way, you will see VIX go up in value. So literally what it is if somebody, if the big boys, because big boys are the ones who are playing VXX, because it's a stock that's actually tied to nothing except for the volatility of the stock market. What they'll do is, if they think it's going to be very volatile, then they will buy positions in VXX, because as volatility increases, VXX increases.
Okay. What increases volatility or decreases it in the market?
What decreases volatility?
Or increases? What makes it?
What increases volatility? When prices are moving down, in particular. Yeah, that's what increases volatility. If you take a look at the history of options prices, since the beginning of the last bull market, volatility has decreased over, well, if you take a look at the aggregate of the entire market, it's decreased ever since the beginning of the last bull market. So when we go into our next bear market, you will start seeing these low volatility numbers that we're seeing right now. They will begin to increase drastically.
So the VXX is setting up for our next bear market?
Yes.
That's exactly right. Which means if you're wanting to be in a call position, let's say that you're in say an IRA where you can't short any stock. Well, you can buy options in most IRAs, and so you can go ahead and put yourself in a position for the bear market by buying, say, VXX, or buying the bear derivative of SPY, SPY. So we'll get into that as it occurs. Right now, I wouldn't buy the bear derivative of SPY for anything, because of not only the price, because it's so inexpensive right now, and because it actually doesn't move very much in comparison to the market. So you're better off buying the bullish derivative, at least at the moment.
All right. Have any questions on this or anything else from anybody else? Or just comments? Just comments, whatever.
Hey, Jimmy, you said you were going to mention to us about how to see the futures.
Oh, okay, yeah. So if you don't know where to see futures, there's three ways that I'll give you. One is off of the app that we provided for a link for off of the resources page at the website. So go to the resources page and you'll find a couple of apps. One of them actually shows the market, and in that market, in pre-trading hours in the morning, you can see pre-market activity, or futures as they're referred to, on a particular stock. It's not 100% accurate. Sometimes you'll see no futures on it, and when it opens up, the stock will gap. Like, well, it didn't tell me that in the futures. Sometimes it'll show, that a stock's going to gap up by $1 or 50 cents or something like that, and it opens flat. So it's not 100% accurate, but it will give you an idea. Another free location is, that app was $10. I think we paid for it, or less. I don't know 99 cents. I don't remember what we paid for it. The free location is Yahoo Finance, so finance.yahoo.com. You put in the ticker symbol of the stock, IBM, Netflix, whatever, and it will show you on that screen in pre-market trading at the top of the screen. It'll show you if it's going to open up or open down. If you see nothing there, then you're going to open flat, theoretically. Again, that's not very accurate. You guys also know that at finance.yahoo.com, prior to the market opening, you can see if the S&P is showing in positive territory or negative territory. The same with the NASDAQ and the Dow. So it may S&P may show that it's going to open up at minus 3%, and actually what happens is when the market opens, it opens up flat. A more accurate, very accurate, very reliable resource for futures is actually with the Platinum package for TC2000. So I have the Platinum package. However, it's running me $100 a month for that subscription. That does not fall within everybody's budget. When it does fall within your budget, I highly recommend the Platinum package for TC2000. If it's not in your budget, go with the cheaper version, which I believe is $29.99. But it is very accurate. Now, it does not show you S&P futures, okay, because S&P is a collection of 500 stocks, and that's very hard to do. But what it will show you is SPY futures, and that's dead on accurate. If SPY is going to gap up, the S&P is going to gap up. It is very, very reliable to see what the overall S&P is going to do. You can pull up an individual stock. I was able to know, for example, on TLT, I was able to know at 7 o'clock in the morning that it was going to gap up on me and give me my profit. I knew that an hour and a half before the market opened. I was like, yeah. So when you can't afford it, do so, because within the fee, buried in the $100 fee a month, is a $10 fee that you're actually paying directly to the New York Stock Exchange for a live feed. And it is very accurate. Any questions about anything else, or comments or concerns? I would like to know, if not, have any of you been having some success on your own with the double day play, whether you're following instant alerts or not? I have a good friend of mine who's not on right now. His account balance was in very bad territory. And he bought a double day play. He saw a particular stock. He saw some momentum with it. He got into it for, I don't remember what it was, 3 cents, and it went to 90 cents. And he'd bought like 10 contracts. He bought 10 contracts, so he spent $30 at $3 a contract. And it went to 90 cents or $90, and he had 10 of them. I was so happy for him. So he got all his money back that he had lost in the stock market over the last 2 years. He got it all back in one play. Has anybody had any success over it that they want to talk about? Oh, come on. Y'all flatline cur dogs, because I've talked to some of y'all.
I have, but I give it right back at the end of the week. Hey, I'm trying to practice the discipline. Now, I know I preach it on the Facebook page quite a bit. I don't know if anybody sees it or not, but that's my Achilles heel. Is I'll make the wins, and then by the end of the week, I give it all right back.
There definitely is some discipline involved, and at the recording of this, I started, my nest egg was $1,500. I went all the way down to $400, and I almost threw in the towel until we did the double day play. We started playing with that. I saw the potential there, and I've slowly built my account balance back from just under 400. It was like 398 to now by Friday it's 550, and I'm taking $20 swings at it, $10 swings at it at a time until I build it back up. If you guys are on the Instant Alert program and are following along with that, it's paying for itself in the double day play, and it has. Now, over the last 3 weeks, we've done very little playing because the market hasn't really moved much. Friday was a very difficult time to make money in anything because most everything other than Netflix we showed you moved. there was Netflix, and you needed to do a straddle or strangled in order to make money with it, because if you bet on a down play, you lost your shirt. There was CRM, which was I put out to you guys, Salesforce. I don't know why their symbol CRM, but it is. And it went the opposite direction of what I thought it would have done. So you would have lost money on that unless you did a straddle or strangle, because then it would have paid off. But it's having the discipline to go, I can't tell what the market's going to do. I'm sitting here looking at the S&P 500, and it's at the top of its trend range. It's either going to bounce and go down or go to new highs. I don't know what it's going to do. So you know what? I'm just going to sit here and twiddle my thumbs until I tell. And if I can't tell, I just won't get into anything. That takes freaking discipline. It really does. But it's taken getting my account balance down to $400 before I could actually learn the discipline to sit on the sidelines and go, well, I don't know, so I just ain't going to do nothing. You know? Now, one of these days, you guys will be in a new bear market. You're going to know what to do every single week. And then when the bear market ends, you're going to be in a new bull. And Katie barred the door. You're going to know what to do every single week. But until then, we have to exercise a little bit of caution and patience, and just be willing to sit there on the side and go, I'm not really sure, so I'm just not going to play. You know? Tanner, you got some thoughts on that? You've been down the same road as I have.
Yeah, that's really what it's about, is learning discipline and patience. Because even in a bear market, you're going to have to, the discipline that you learn right now, you're going to be able to use it for a very, very, very long time. So the idea is keep as much money dry. That's why we love the double day play, because you can use very little of your capital in order to get into something that potentially could pay off 4, 5, 6, 7, 800%. If you're wrong, you lost very little. If you guys have been following us for a little while, you know that the largest play that I got into recently was $3,600 in one position, and I lost $1,500 in 3 minutes. Well, why risk that much money all at one time when you can risk pennies, maybe $1, maybe $100 at a time, and the most you can lose $100? And you have the potential of making the same amount of money off of both plays. So,
you know, truthfully, the best thing to happen to us, Tanner, talking specifically to you and I, the best thing to happen to us was the fact that we started losing money in a very stressed, depressed, worn-out bull market. Because if we wouldn't have been in that position of, well, for me, it was absolute desperation, we would have never discovered the double day play.
That's correct. That's exactly right.
Now, I will tell you to be patient, okay? Because with the double day play, and I'm about to prove it, so everybody pull out your calculator. I'm going to pull out my calculator right now, okay? I'm going to prove to you that you can make $1 million in 3 transactions, okay? Everybody's greed and ego just kicked in and ears perked up. What? Yes, you can make $1 million in 3 transactions. How can you do that? Well, first of all, I can't do it right now because I don't have enough capital to play with. But there is one person that's on this show or listening. He's one of the listeners right now. I'm not going to divulge his name because he hasn't given me permission to do so. He's got $27,000 within his account. He can do this because within his operating budget in spending money on options, he can drop $2,000 on options. Okay, I wouldn't drop more than that, even though he had $27,000, but he can drop $2,000 on an option. Well, I don't know how many times I've seen an option make 800% return on an investment. It did it Friday with TLT. I just bailed out of it when the market opened. Okay, so let's do some math. Let's say you got your account to You finally got it to $10,000. You went from spending $20 in options to $50 in options at a time to $100 to $200 to $300 to $500, and you eventually said, I got $10,000 in my trading account now. I'm going to risk $2,000 of that on this play because I think there's a really good chance it can give me that 800% return. So let's do the math. $2,000 plus 800% is $16,000. Wow, yay. It's a total of 18 with the original $2,000 that you spent. So 18,000 now that you have grand total. All right. You don't peel off any of that profit. You dump it all into the next trade the very next time that you think you can get an 800%, a TLT situation like we had on Friday. 18,000 plus 800%. You just made $144,000 in profit plus the original $18,000. We're now at $162,000 in transaction number 2. If the $162,000 entirely reinvested in the third trade plus 800% return on your investment, you now have $1,296,000 in profit plus the original investment, bringing your total to $1.458 million in 3 transactions. That's mind blowing. I was telling DJ who's on the phone, and I'm like, I don't know if I could get past transaction number 1. I think if I invested $2,000 and made $16,000, I don't know that I could have the heart to actually attempt to do it again. Now, if you put your mind in the fact that I'm still only investing the original $2,000, well, it becomes easier. But I don't know about you, dropping $160,000 in trade number 2 for that third trade, knowing that it could go against me and I could lose it all, I just don't think my heart could take it. But is it possible? Absolutely.
Yeah. 9 or 12 transactions would probably be a little safer.
A little bit safer, yeah. But
Keep
still
splitting
remember,
each one up.
But remember, you still have the original 8,000 left over from the 10 that you earned sitting aside in case you lost it. Okay? So put that in the old memory bank and think about it, because if you keep taking these, nickel and diming yourself, taking these little short swings with the double day play, you're going to build your account up, especially if you do the opposite of what Greg has done and quit giving it all back.
Yeah. You got to see this. Well, you can't see it, but I have 3 whiteboards, red writing, take profits, quick pops, lock in gains, stay disciplined, all these right in front of me. They're trying to help me take them, lock them in, and stop trying to hold for home runs.
Yep. Yeah. Does anybody have any? Did anybody believe that the double day play could be that profitable that quickly? We just haven't got to that point. Okay. One of these days, hopefully within the next few months, you guys will build your account up to where, you're not taking a $20 swing, you're taking a $500 swing or a $1,000 swing. Now, there is a caveat to that. Is not quite based in reality, and that is if that option is going for 2 cents or $2 for a contract, and you've got $100,000 to invest, well, when you get ready to do a market order to get out of that thing, it's going to be sold off in blocks. The market maker has to find a buyer for your option. So if he's trying to find buyers for your option, you're not going to be able to sell the entire block. Okay. And so you may not make the same amount. You may make 800 off of 50 and 750% off of, the next 50 or whatever. It's going to fluctuate. Something else that you have to consider is there is a cap to how many options that you can buy. And what is that cap, Tanner?
25,000 in one position.
In one position. You can only buy 25,000 options in one position. So if you're buying them at 2 cents a piece, you're going to run into your cap pretty quickly if you've got that kind of capital. So
Once we
there
get to
is-
that point, we have another strategy that we'll teach everybody. So just get ready for it.
be very, very quiet.
I am.
Option 1, make money. Goal 1, make money. Goal 2, pay off my debt. Goal 3, become wealthy. Yeah, that's ultimately, and I want to remind you guys, that's ultimately, and I have to keep beating myself in the back of the head, that's ultimately my first goal, is to eliminate debt. I don't want to owe nobody nothing. And I want to have enough cash in my account that if something god awful happens to my family, that I could turn around and not have to worry about it, because I can meet that disaster in my life with enough capital to offset the damages. If I want to buy a new car, I don't have to finance a single dime of it, that I could just go down there and buy myself whatever I want. I want to be in that position. I want to be in that position not because I want to be rich. I want to be in that position because it's the right thing to do for my family, and it teaches great discipline and how to live a financial life to my children that I'm going to leave behind me, and I don't want them to make the same screwed up mistakes that I made. So keep reminding yourself, because every single one of you out there have some pretty horrible spending habits that if we dug into your finances, yeah, you know it. You've done some bad things with your finances too, and that's one of the goals, is to get out of this. Greg Price. Okay. Anybody have any other comments before I finally close this down?
Yeah.
I heard a yes.
What does the color blue taste like?
Oh, shut up. That's my crazy, stupid friend. You know what, DJ, before we finally close off, I want to give you an opportunity, because probably every single person on the call is somebody that came from the Photo Tips podcast, which means there's a really good chance that you got some help from these guys. And I know you've wanted the opportunity to actually personally say thank you. I'm going to give you that chance. First of all, tell them, for the sake of the podcast, tell them what happened to you and what some of these guys did for you.
Okay. Back on May 20th, 2013, an F5 tornado tore through my neighborhood and took the house down around from myself and my wife. Then my friend Jimmy here, he reached out to his podcast friends and followers and asked them for help. And they more than stepped up. With the help from FEMA and the help from your listeners, we were not only able to replace everything that got taken away, we were able to get a lot better stuff than we ever had. In fact, the computer that I'm using right now to log into this was built by one of the viewers and was donated to us. And I can't say thank you enough on just that alone. The big jerk's going to make me cry. I pray that blessings are put back into the lives of those people who helped me and my family.
Yeah, his whole family, DJ, his wife Cassie, and his son Chris were very, very thankful. Within the very next day, we showed up at Walmart. DJ and Cassie and Chris were wearing the same clothes that they were in on the day of the tornado. Chris was in high school, but they were in their house when it was completely leveled. I don't know how he lived. I really don't know how he lived. He was absolutely filthy from head to toe from the mud and the water that swirled around and the debris that was in the air. He was filthy. He went home, stayed at his mother-in-law's house, took a shower, put on the same filthy clothing because that was the only thing that he owned. And within the time that he went to bed, reaching out to you guys, to the very next morning, we were at Walmart at 9 a.m. We spent $800 of your money buying him brand new toiletries, underwear, socks, T-shirts, a comb. Just think of the stuff that you women need to have to survive. She didn't have any of those things, and we were able to immediately put things in a couple of baskets and begin to replenish their life. I think in all total there was roughly $7,000 in cash that was raised, plus boxes upon crates of donated clothing, some of it brand spanking new, that they couldn't use it all and had to turn around and give to other people. It was a fantastic thing that you guys did, and I can't tell you thank you enough for stepping up and doing what you did for somebody that you did not know. It was awesome. So, having said that, we're now going to officially close, and I would like to start closing these out in an official capacity with the following thing, and I want to ask Tanner to pray to close. So, Tanner, you lead us in prayer at the end of this thing. Pray for these people. Pray whatever comes to your mind. Just speak your heart, brother, and we'll end this thing.
Okay. I want one illustration first. I have a question for everybody. DJ said something. What color does the blue? What does the color blue taste like? So that kind of spurred a thought in my mind real quick. My question is what color is a lemon? And the
Yellow.
answer is yellow. Okay. Well, what color is a lemon in the dark?
Yellow.
Actually, the answer is it's black.
Okay.
Color is a secondary property that requires an external influence in order to be realized, and that is light. And and the reason why I bring this up is because this is really what my life is all about. Is I love studying Scripture and I love talking about it. And so the Scripture says that Jesus is the light of the world. So without Jesus and without the light, everything is colorless. So what does yellow taste like? Well, if you're eating a lemon, it tastes like a lemon. Okay. All right, that'll give you a little bit of insight as to the insanity that's in my head all the time. Okay, so now I'll pray. Father, I thank you. I thank you for the opportunity to live in this country, the opportunity to have opportunities to take care of our family and to reach out to friends and relatives. Well, God, I know that our initial push into options and into trading is to benefit our families and to benefit our friends and to benefit the people that are part of our life. So, God, I pray, Lord God, especially for wisdom. The stock market is something that I would call a beast. It's something that's designed to take money out of people's pockets on a regular basis. However, God, I believe that you've given us enough wisdom and enough knowledge and enough understanding to pull profits out of this market and out of the market. So, Lord God, I pray for the individuals that are on this, that they will have the wisdom to see opportunity and have learned the disciplines that are necessary in order to not only see opportunity but to take advantage of opportunity and to lock in profits when profits are there and not beat themselves up about the fact that maybe it continued to move in their favor had they just waited. Well, God, I just want to learn what I need to learn from you so that I can not only have money but do the right thing with it. I want to do the right thing with money. Money is just a tool in our hands. And so, Father, I want to do the right thing with the tool. And so, Father, I pray ultimately a blessing on every hearer, everybody who's listening, everybody who will listen in the future. Lord God, just bless them immensely. Bless them with financial prosperity. Bless them with spiritual growth in getting to know you and seeing and ultimately realizing that Jesus is the light, and he is the light of the world. And I just thank you, Lord God, for these people and for my wonderful friends. And as we get to know one another, I pray that the relationships will just continue to deepen. And I thank you in Jesus' name. Amen.
Amen. All right, that's it, everybody. I appreciate everybody joining in. We'll see you next time, and stay frosty. Peace out. Bye.
Bye-bye.